Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over interest rates. And I hear people, and I'm going to go over market crashes too. Market crashes and interest rates and kind of how this all ties together. Some of this has a very, we'll call it the thesis of the channel kind of intertwined into it as well. And I think it's a good topic to cover because I keep hearing people that they're so worried about a market crash. And maybe a market crash is out there, but the underlying structural deficits in this market are going to manifest themselves eventually. They have to. And that's why I kind of want to go over it. And interest rates, a lot of people, when they talk about interest rates, they act like interest rates are the driver of these changes. They are not the driver. In my opinion, they're not. They may influence certain things, but they're not a driver. They're not a driving factor. The way that I view it is that, and maybe I'm viewing it incorrectly. If you think I'm viewing it incorrectly, definitely put some comments below. But the way that I view it is that demographics is the driver of some of these, we'll call it, it's the driving force behind inflation. Inflation is the driving force of interest rates. The inflation-deflation aspect of it. Now, if demographics is driving this, and it drives inflation and it drives interest rates, then you could say that demographics impacts the way that assets are priced through interest rates, which is a second order away, if that makes sense. So the thesis that I have is that demographics drives real estate drives interest rates drives the pricing of all assets. And that driver there is larger than the fundamentals of a single company, because that is where money gets directed into and flows into certain asset categories. And I made in a comment that fundamentals don't matter. Fundamentals, they matter, but what I'm talking about are market conditions. The way that some of these tech companies have gotten so overpriced was because of the market conditions. It wasn't because of the fundamentals of those companies. Tesla's fundamentals does not support its market cap. Then how did it get there? The fundamentals of oil companies at the bottom did not support any money going into it because they were absolutely horrible and they were about to go bankrupt. But guess what? Commodities went far higher very quickly, changing the fundamentals of the company quite rapidly. So the market conditions have a larger impact on fundamentals of a company than what most people are giving it credit for. So how does one choose a company or companies based solely off the fundamentals of the company, where a lot of these companies don't even control their asset price, the commodity that they sell? Also, the PE ratio is derived from the interest rate and the abilities or the appetite. I'll call it the appetite. It's not abilities. The appetite for risk. So if your interest rates go way down, everyone piles in on the risk on assets. Risk on being the tech companies and all that. They are searching for something. They can't go into bonds to get a return. The market conditions set that scenario up. It had nothing to do with the companies themselves. The fundamentals of that particular company are not driving money flows into it. The market conditions are influencing where money is flowing. And we can see it in the ratios. Now, another thing I want to talk about with ratios. Ratios are nothing more than a risk-reward bet. You're looking at the risk-reward. Your risk, your downside risk, when your ratio is way down there, is very low. Your valuation runway ahead of you is a ton. And then you can pile on leverage with companies or whatever it is, if that's what you want to do. And then managing, if you have a low-risk bet, so let's say it's platinum, and I'm going to use platinum as an example. You have a ratio that's incredibly low. the risk reward is very, very attractive. And you can take a physical bet, and let's say the potential payout could be 5 to 10x. From $1,000, it could be 5 to 10x. Now, I was buying platinum quite dramatically in the crash of 2020. It was my lowest purchase price was $600 and something, but I only got 1 ounce because that's what they limited me to. They didn't allow me to buy multiples. They capped it at 1 ounce. But I got a lot in the $700, $800 range, a whole bunch. And I just kept buying it. Now, the upside from there is going to be probably greater. It could be a 10x from there. Maybe platinum goes to 15,000. I don't know what the necessary upper cap is. I don't have that crystal ball. I don't know what the blow-off's going to look like at the end of this inflationary period. Remember, inflation is going to push all these things higher than what we think. So with a risk reward so great and favorable, you could play the physical metal and get that return. You don't have to speculate and try to completely amplify that move. Now, when do you speculate? You speculate when it's the least risk way, the least risk time. And right now it's pretty good. So you can go into some of these mining companies if that's what you want to do. But remember, it's a risk adjusted return. You want to make sure that you don't pile all your money in it. If you're a new investor and you're young, it's about continually progressing all of your net wealth forward. It's about moving step at a time, continually getting good returns every single year if you can do that. It's about progressing forward. You don't want to be putting all your money in these very high risk areas and then getting completely blown out to the downside and losing that capital. So what I have done is I only put my stuff in high risk areas, 20% of my capital. That's it. I limit it. Boom. Now that can grow and be very large. It could be 40% of my net worth at some point. And then I start rotating that money back into physical metals and then doing my physical metal game. Because that will also increase your ounces in your possession. So I've got 2 games playing. And then I've got the real estate game. And I continue, if real estate crashes in we'll say 10 years, that's probably about the time frame. We get a nice crash. Let's say it's about 5 years after that, about 15 years. That's about when my kids will graduate high school. I'll probably buy another place at the bottom of the market and get something that I want. That works out very well for timing in retirement versus kids going to school and all that stuff. So that it's about perfect to do a switch. Now, what I have behind me, we'll jump into this. Largest age cohort, medium age first-time homebuyer, 33. This was in 2020. We're coming into an area where the demographics are becoming more and more favorable to buy homes. And what I have underneath here is housing shortage, 5 more million homes needed for supply to catch up to demand. We have a real estate shortage. Now, looking at history, just to kind of go through here, this is the housing starts and the real estate cycle that you can see through housing starts. You have the M2 money supply, which is the black line. The red line is inflation. And I have this kind of about as good as I could line up the dates. 1980, 1980, 2000, 2000, 2020, 2020. I got it lined up pretty well. And if you notice, the M2 money supply goes up and down based off of the housing starts. I am saying that the housing starts is a leading indicator of the M2 money supply. At least that's what it's been in history. As we get further in time, on the right-hand side of the scale, they're printing a bunch of money and they're throwing stuff all in this M2 money supply on top of the real estate cycle. This, they didn't do any QE. You can see how kind of raw this data is and how it cycles up and down. The M2 money supply, and then the inflation is just lagged a few years behind it. 2, 3, 4 years, something like that. And you can see how this is all lined up, and then how it goes all wonky over here because inflation went way down and they started printing money, but we are in a deleveraging phase. You can't get money into the system through loans if your area is deleveraging. If the housing market's deleveraging, you're still going to have lower inflation. And this is the one time where we had a deflation was from this real estate housing market crash And all these recessions in here are from real estate pulling back and crashing. It's a deleveraging process. So when the housing starts fall, when inventories get, we'll call it restocked, you get a decline in the M2 money supply and a decline in inflation eventually happens. And then we've got this huge money printing, I don't know what the heck they're doing thing over here, which is just, it's adding more inflationary pressures into the system. Now, will this be transitory? It probably will be at some point. It will go way up in inflation and then we'll kind of calm back down, but it may remain at a very elevated level if we're going into an expansionary phase of real estate with a demographic that's coming right behind it of larger buyers for real estate. And you've got this housing shortage of 5 million homes that you have to catch back up, which means we can go into a very large expansionary phase of real estate, which will be increased inflationary pressures that are structurally driving the market. And here's interest rates. This is the 10-year Treasury yield. This here does not influence this. I mean, it's not as great of an influence as you think. This is really it's a supply-demand imbalance in real estate that is driving this. It manifests itself in more new homes being built, and those new homes get new loans against it. Those new loans are inflationary because you have a new loan against a new asset, and that new loan is 100% inflationary. So the higher this thing goes, the higher we go here, the higher this inflation rate, the M2 money supply goes. And it will level off and come back down. That's what these two humps are. And eventually, if you have too much of an imbalance and you have too large of a demographic coming through, interest rates are going to have to go up. That's why we have QE. So interest rates are not driving the housing market. The supply-demand imbalance is. That's why we have, and I'll show you below, increasing house prices, increasing rent prices, active inventory is being depleted. That's what happens when you come out of a recovery phase into an expansion phase of real estate. Your inventory depletes, and that's what kicks on the new homes being built. You're going to have to build a bunch more new homes, and that's what this 5 more million homes needed for supply to catch up to demand. We have to build our way out of it. We're short 5 million homes. And if we're short, we should see it in increased rent prices. So here's your active listing count for October of 2021. That's last month. And we are still way under every other year, and we're declining in our inventory. Your active listing count inventory. This here is driving real estate prices higher, far higher. Now look at this. It says since 2012, home prices have grown 1.6 times faster than rent. The first thing that happens in a recovery phase, that's what this phase is down here, recovery phase, is your inventory is going to start getting eaten up. That's what this is. This is your active listing count. And over time, 2016, 2017, 2018, 2019, your inventory is being drawn down. We can see it over these years in a recovery phase. When you get to critical levels, the real estate price rockets higher. And it will outperform rent over time. It'll outperform it as inventories get depleted. The next thing that will hit when your inventories get to critical levels and people can't buy homes is they're going to have to rent. And then guess what happens? This is what they put. Pandemic pricing is officially over. National median rent, as it goes up, it's seasonal. The seasonality goes here, but look what happened. They had this crisis and then it just shot higher and is accelerating quite dramatically. We don't have the inventory and people can't buy homes, so they have to rent. Rent prices are going to go rocketing. Then you've got this inflationary soup mixed in with it, which is also going to drive it higher. So we've got all of that going on. And what my thesis is here, I'll just jump in real quick. My thesis here is during this time frame, you're going to have inflation. Inflation's going to impact interest rates. It's not interest rates impacting inflation. It's the other way around. The demographic is driving this. It's structurally driving this. And when inflation comes from not only just the money printing that they just threw into the system, but when the inflation comes from the expansionary phase of real estate, which will probably last 10, 11 years from 2017. So 2027, 2028, 2030, somewhere in that range. I can't tell you exactly, we're too far away. But it's somewhere in that range in there. We get the inflation coming in, it's going to put pressure on interest rates to go on up. Interest rates go up under expansionary phases of real estate. Look at history. It means that when house prices get to the supply-demand imbalance gets too out of whack, house prices start rocketing higher, that is what's going to increase your interest rate, is all these new homes being built, which is it's a leveraging up of credit, more credit expansion. You can see it in Japan when they had a little bit larger demographic come through and their house prices recovered some. Their interest rates went up during that time frame. Now here's something I want you to ponder. In 1980, did Paul Volcker kill inflation, or did the demographic run out? The demographic ran out. He was lucky. He got accredited that, but it was the demographic and this housing, the new homes being built ran out of steam. You could see it right here. Right here. That's where it came out. It blew out. We had a deleveraging phase. And then we came back and it wasn't as big of a cycle here. We could build 2 million homes, which is up here, for 10 years, which is a pretty good expansionary phase to basically give us the inventory that's needed for all these people. So coming back here, if my thesis is correct, we should see commodity prices starting to get revalued higher because interest rates are about to go up and people are going to anticipate this. We know the values there. We know our risk-reward ratio is fantastic down here. And this is probably going to last for, it could be 10 years, 5 to 10 years. I don't know the exact timing. It depends when the real estate market builds all these new homes. But here it is. We broke the downtrend line on the CRV to S&P 500. We're coming on up and we broke it. And this right here is a higher high. So we have a higher low. We have a higher, here's our high. We broke through it. We have a higher low from back here. So this is a higher low here. And then we broke it and created a higher high. This is a new uptrend. This is exactly what I look for in technical analysis. We are coming in a downtrend. We squared up that down. We squared it up right here, kind of broke through it. And now we're going to start moving on up. The big moves haven't even happened yet. That is what's insane. Here's our long-term big picture view of the commodity to S&P 500 ratio. Buy, 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 sell, sell, sell. This is your valuation runway. This is your risk reward. The further down in this ratio, which we are way down there, the further down that ratio, the better risk reward you have. And we just turned up in a new uptrend. That's the lowest risk spot to buy, is when the ratio is low and you just made a new uptrend. It's right there. Your risk reward is fantastic. Now here's something else that I want to cover. Good news for stocks. The ratio of gold's price to platinum price over the last decade. It's favorable for equities when gold outperforms platinum. And this ratio goes up. It is unfavorable when it goes down. Gold's price to platinum. What does that mean? It means that all this ratio is telling you, it's telling you something about the market conditions. The market conditions is what drives assets. The pricing of assets. Lowering interest rate environment, money piles into stocks because it's low inflation, low interest rate. When inflation kicks up, it drags those interest rates higher. It's risk off. You don't want to be on risk on. It's going to contract the PE ratio of stocks. This ratio tells us that exactly, because I'm going to show you down below here what I've got. This is what it means. This is real assets. This is the inflation. This is how under inflationary conditions, this is how assets perform during inflationary periods. Long-term government bonds eat it, obviously. Now, if we go all the way up, real assets perform very well, 73% correlated to inflation. Commodities, platinum is way up there. And what this is saying, and since platinum is higher than gold, gold is down here, platinum is more inflation sensitive. You get higher returns under inflationary periods for platinum than you do gold. And what that means is that when this ratio of gold's price to platinum, when this ratio, it means that when platinum's outperforming gold, that we are in an inflationary environment. And under an inflationary environment, stocks underperform. The market conditions drive the returns of assets, the valuations and market conditions. So under this, we've got diamonds, and now diamonds is a sector that we also have synthetic diamonds. They can make diamonds, so I'm not too keen on that. But I like gold, real estate, platinum, silver's actually down here. Palladium doesn't do as well as platinum, and that's, remember the ratios. Why am I swapping my gold and my palladium for platinum? And I think there's supply-demand imbalances in silver. That's why I also like silver. But I think platinum is a steal of a deal right now. If you guys like physical precious metals, because of the inflation aspects that it has and the performance it has under those inflationary environments. Commodities right there, the highest leverage commodities. When I did some calculations and I put it in Excel and charted all this out with the ratio contractions historically, the best performing inflationary assets are uranium, oil, and natural gas. Those energy sector ones kill it. Kill it. So where did I put my money? Everyone knows this on the channel. I put it in energy. That's the best risk reward. Now, we had ratios in oil that blew out to the downside. Absolute blowouts to the downside. Ratios that were never seen in history. What do you think I did? Bought it. Why not? My accounts are up quite substantially because of that. And I went after the higher leverage stuff. Because that's the only way I know how to play oil. I can't physically stockpile it. So I bought, oil exploration and production companies. Ones with high debt. If oil is one of the best inflation hedges, that means the debt will be eroded away through the price of the commodity. It's pretty smart. I like that. So I'm in heavily in uranium and oil and natural gas. Now, what's so great about uranium? Uranium has an inelastic price demand. It doesn't impact the end user very much. So the price can go absolutely ballistic if it were to get squeezed. And I think it could get squeezed. And if we have a very inflationary environment, your gold price is going to go up quite substantially, and the uranium price could go quite ridiculous. So I think with the limited amount of companies in uranium, it's probably one of the best bets that I know of. Because money's going to funnel into it, and it doesn't have really anywhere to go except for these small little companies that are so few. I mean, so it not only does it have the greatest leverage of any of the inflationary investments that we can partake in, it gets funneled into nothing. This is like cheating, guys. And if you can structure the portfolio very well, where it's not about winning every single bet, it's about betting on a bunch of different horses, where the payouts are so large, this asymmetric bet that you can have here, it's so asymmetric where you put up 100% of your capital and you could return 100 times. And maybe some of them, if it's an exploration company and the price goes ballistic and they find something during it. That's like the perfect mix. And maybe it'll happen, maybe it won't. But if you can find just one of those, it'll transform your portfolio. If you have 7 to 10 possibilities and you put $1,000 in each, you could lose on 9 of them, hit one lucky winner, and return 100 grand on the one winner of 100 to 1. It just becomes a betting strategy then. And what the probability is. And last time, when you look at the last bull market, they all won. Like the worst of the bunch was up like 20x. I mean, that's like, that's ridiculous. It's like you have to be in it. Now back to this, in the inflationary time and interest rates and all that. And I'll read this real quick. It says, consider an academic study by Daring Hung, a former finance professor at Cornell University, and Mede Killick, an assistant professor of finance and business economics at the University of Southern California. They found that the gold to platinum ratio is a good stock market predictor. A falling ratio is bad news for equities, while a rising ratio is bullish. Why would the gold to platinum ratio be able to forecast the stock market? In interviews, when the research first came out, Hung explained to me that it has to do with the different factors that influences the price of the two metals. Platinum primarily reflects industrial demand, while gold price reflects both industrial demand as well as investor demand for a hedge against economic and geopolitical trouble. Now, what I would say is it just goes back to this chart. Platinum has a heavier return during inflationary periods than gold does. That's all you need to know. So when platinum outperforms gold, when this ratio goes down, it's not favorable for equities because equities doesn't like inflation. And inflation basically pulls interest rates higher. And the increasing interest rate environment, stocks do not like that. They get priced differently, and the flow of money goes into commodities. Now, here's the gold to platinum ratio real time, just to show you what's going on. Now, if you know how to read charts, you've got just a simple trend line that I drew in here. What happens is you go upward. This is gold outperforming platinum under this disinflationary environment where platinum does not like that. What happens first is you have a blow-off top, which we got in 2020 in March. That's your blow-off top. And I'm speculating here, guys, on the blow-off. That's where I loaded up. It was all in this area where the ratio was ridiculous. I traded not all of my gold, but some of my gold for platinum. I traded my palladium for platinum, and I loaded up on platinum because I think that an inflationary period is coming. And I'm using this ratio to basically validate and verify that that inflationary period's coming. Platinum broke through its downtrend, and what it's doing, and I like how I've been watching a little bit of Francis Hunt on some of this, and I like what he says. It squares it up. And that's what I always say. You have a move upward, you have a move sideways, and then you have a move down. He calls it squaring up, and it's a great way to say it. What is platinum doing behind me here? It's squaring up its move. It's slowing the momentum down. Where we broke out, we came up and created a retest of this line break. And then we're going to come back down. And if we break this 1.4 area, we are in a new downtrend, which means that platinum is going to outperform gold. And it has all of these other ramifications where equities are going to underperform. Platinum's going to obviously increase its purchasing power against gold. I think platinum's going to outperform silver. Why do I think that? Under inflationary periods, platinum outperforms silver. Where silver goes crazy is the back end of this inflationary cycle. And silver can do great. It may do great the entire time. Remember, guys, these are trends. They're not 100% outcomes. So why do you think I own silver? Why do you think I own gold? And why do you think I own platinum? Because I could be wrong. No one's 100% right. So I've hedged myself. I said, I'm going to overweight what I think is going to do well. I overweighted silver because it was easy to get, and I overweighted platinum. And I underweighted gold. Because if the platinum gold ratio contracts, which it should under an inflationary period, and it is, that should outperform. And the ratio is ridiculous against all the other metals for platinum. So what does this mean for interest rates? It means that an inflationary period is coming, and we can see it through the gold to platinum ratio. We can see it in the commodity to S&P 500 ratio. Why am I showing you all this? They're all creating these new uptrends. Why? Why is that? Because that is validating what the market thinks about the humans interacting in the market are creating these patterns. If commodities are an inflation hedge and if platinum's an inflation hedge, then they should outperform stocks, large cap stocks and small cap stocks. Financial assets are way down here. So if the market, and remember, I get my signals from the market. I don't get it from YouTube. I don't get it from some opinion of some analyst or whatever. I get it from the market. So in order to understand this, you need to know what what impact inflation has on assets, what assets outperform during inflationary periods, and what assets underperform. If you know that, this chart I have right behind me that I just showed you, I'm going to come back to this. If platinum performs better than gold under an inflationary environment, and we're putting in a bottom, what does that mean? Well, it means that we're coming into an inflationary environment. Check, that's right. Now, if we have more confluence, the CRB index is outperforming the S&P 500, that chart right here, and it's just putting in a new uptrend. It's just putting in a new uptrend. What does that mean? Well, commodities are outperforming stocks, okay? And why is that? Because you're entering an inflationary environment. That is this chart is validating that thought. The market is telling you that inflation's coming through the gold to platinum ratio. It's telling from the CRB to S&P 500. It's telling you from the copper to gold ratio. People are choosing those assets over stocks and other ones. We can see the money rotating in these charts. No one needs anyone to tell you that. It's in the charts and it's telling you this. We can see the rotation happening right in front of us. And what's ridiculous is our risk reward here is absolutely phenomenal with where we are in relationship to history and where commodities are priced to stocks. What that means, this ratio way down here, it means that everyone is piled into the market conditions in this last 10, 12-year period from 2009 till today. In this period, they all went into stocks and bonds. And they didn't go into commodities. That's why the ratio is so low. And we're seeing that ratio turn. With the valuations so low, your risk reward is phenomenal here. You've got a bunch of upside with very little downside. Now, don't let these people scare you. Look at these charts. These charts, if they're going in an uptrend like they've just started, they can't be wrong. That's the market telling you those signals. The market is literally telling you inflation's coming through these charts. Interest rates going up are telling you that inflation's coming. Now, we've got some work to break through. I think I had the 10-year yield up here, didn't I? Yes. Here's the 10-year yield. If we're right on this real estate over here, which I'm pretty sure we are, this just doesn't crash back down when you're 5 million homes short. This should break to the upside. We're just right there breaking. Look at that. We're right there trying to break out. If that thing breaks, and I have no reason not to think that because we've got the commodity to stock ratio going up, we've got platinum gold outperforming, all of our measurements are saying, yes, inflation's coming. Yes, it's outperforming. Validating, verifying, everything saying yes, 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 yes. When that thing breaks, you're going to see more rotation of money. You're going to see more people start flowing over to the undervalued assets in commodities and precious metals. If that's the case, if that works, all that money is going to rotate over. And these are much larger sectors than the sectors that are accepting the money. So you're having big money rotations from stocks and bonds, which are far larger markets, going into these little markets, which means prices have to go far higher to equalize all this stuff out in terms of a bunch of trillions of dollars going into a 40 billion uranium market or 45 billion or whatever it's at. And all these charts that I'm showing you guys, they all mean something. It's the way that humans are interacting with each other. And what we're doing is we're gauging the opinion of millions of people interacting with each other through charts. So fundamentals do matter, but they're subject to greater forces called market conditions. And market conditions guides where money flows into what sector. I didn't come up with this overnight, guys. It took me a while to figure all this out. And I'm still refining all of these things. I'm going to refine. And I'm trying to get better as a trader as well. So not just trading to trade. I'm trying to become a very good trader to knock out bottoms, to get more confidence in the charts on the long-term picture. The risk rewards here are fantastic. Better than I've ever seen in any other investment in my lifetime. I'm 40 years old. Been doing it for about 18 years. And believe me, I didn't know what I was doing in the beginning. I was like everyone else. I had to start from scratch and figure this stuff out. So if you guys feel a little overwhelmed, it's okay. Just keep coming, keep learning, keep driving forward. And remember, this is another thing I want to leave on. It's not about the risk that you take. It's about the rewards that you get and compounding that over and over. If you have a very low risk bet and you know that the returns are going to be quite substantial, 5x, 6x, 7x, 8x, that means you can 8 times your money or 5 times your money over a 5 to 10 year period. I mean, guys, pick that money up off the floor if it's easy to do. Don't necessarily go after the high risk stuff, which could pay a 15 or 20x. It could be a far higher return. You can still go into it, but adjust your risk appropriately. Managing your risk is just as important as the return. If you have no upside in it and you have a lot of risk, never take that bet. Never, ever, ever, ever. If you notice in some of the companies that I go after, if I have a very high reward, low risk entry point, I hit the full send, full risk button a lot of the times with my smaller portfolio. Why do I do that? Because the juice is worth the squeeze. If I can't outperform a physical precious metal, I go straight to the physical metal. So when someone said, why don't I own Camco? Well, if I can get roughly the same return on a precious metal, maybe, or somewhere close to it, or maybe I could get roughly the same return in physical uranium, I'm just going to buy the physical uranium. Buy the fund. Buy the fund that tracks it, and you're good. If I'm going to go and buy a mining company where Camco is subject to the same risks as, say, some of these other ones, and maybe it's a little lower risk, but they still has a lot of the same risks, then I'll just go full send on it. Because the risk difference isn't very much, but your rewards are massively different. It could be on an order of magnitude of a 5x difference or a 10x difference. If I can get 5 or 10x more out of this smaller company than Camco, and I'm subject to roughly the same amount of risk, screw it. I'm going to go with the higher risk company. But that's me. And remember, I'm appropriately position sizing these things out. So I manage risk through position size and when I buy it. Hopefully this gets you where you want to go. Give me a thumbs up for the content, guys. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.